for joining us. I'm Shannon Grein, and this is my colleague, Tim Quinlan, and we're here to discuss the latest economic data and how it's factored into our forecast. So Tim, I say that, but we haven't materially changed the forecast over the past month. Maybe you could just start off by walking us through why.
Yeah, so I mean, if you go back to kind of since Liberation Day, basically, we've had this mantra that the tariffs would introduce kind of a mild stagflationary shock to the economy. And you could be forgiven for coming away with the impression that, tariffs are actually stimulative to the economy. The way for basically 3.5 months, economic data came in better than expected. Financial markets kind of found their way to record highs. You go back to July 15th, you and I published a note called Hiding in Plain Sight to basically tease out within the consumer dynamics where we're seeing evidence of tariffs having this negative impact on the economy. So in that, we talked about discretionary services spending declining on a year-ago basis, which seldom happens outside of recession. We talked about goods spending kind of hitting an air pocket around the timing of the tariffs coming in. And then lastly, how retailers and wholesalers were pulling forward a ton of excess inventory, and that was kind of shielding prices from an immediate pass-through effect from tariffs. And, it felt a little bit like we were kind of out on a limb with that view at the time, because there was this conventional wisdom that actually the economy is absorbing the tariffs without a lot of fallout. That was only, 3 or 4 weeks ago, and all of a sudden, the pendulum has swung in the other direction. Not only have the data come in a little bit weaker, but it's brought with it negative downward revisions. The jobs reports may be a great example for that. So July, we added a little bit less than expected in terms of jobs, but the bigger story there was this net downward of revision that took more than 250,000 jobs from the prior month's data away from it. So I want to transition this now, Shannon, to ask you about the Fed, and I've got the perfect transition thing for it. In June, we wrote a report called A Better Measure, in which we talked about PDFP, or basically what's left after you extract trade and inventories from the GDP data, and how we talked about that being a better read on things. And then at the last Fed meeting in the press conference, Jerome Powell said basically PDFP, which we find to be this better gauge of where the economy is actually going. And we kind of fist pumped, like, let's go. He's kind of on vibe with where we are. So given this kind of deterioration in the broader economic data, how do things kind of play out for the Fed from here?
Yeah, so that measure of underlying private demand that you referenced grew just about 1% in the second quarter, which is down from the roughly 3% pace that it ran at last year. So this kind of, I think, summarizes what you're talking about in terms of that downward pressure that we've seen on the economy in the first half of the year that came through revisions and came a little bit slower than expected. But given we haven't made much changes to the overall forecast, we haven't really adjusted the Fed call either at this point. So we still look for them to restart easing in September with a 25 basis point cut, followed by potentially 2 more cuts this year, which gets you to a range of 350 to 375 on the Fed funds rate. So slightly above where we probably estimate neutral is. So not stimulating the economy, but not being overly restrictive at that point either. A lot of the outlook around Fed policy and economic growth in general comes down to tariffs, though, right? So you mentioned this at the onset with Liberation Day being kind of that first step in terms of potentially seeing weaker growth. And we've seen some recent developments in terms of tariffs. So President Trump came out and adjusted the reciprocal tariff rates across 60 or so countries, I believe. We've been doing a lot of work on that in terms of the calculations and the table, the tariff tracker that we've been publishing. And more recently, Trump's been talking about pharmaceutical tariffs, semiconductors, and potentially even higher tariffs on India or the EU, depending if they meet their obligations that have been set forth. So I think tariff policy is going to remain really fluid and probably be escalated further from here. So the effective tariff rate by our estimates is around 18% under current policy. Maybe that goes to 25% with about 90% of imports exposed when we consider these product level tariffs. So I think higher tariffs are coming, and where they ultimately settle will determine growth and Fed policy and things of that nature.
Yeah, I think you're absolutely right in terms of the communication that we're getting from this administration, that the direction of travel is toward higher tariffs. I think a question that people aren't asking yet, that it could become an interesting thing for us to think about, is if the tariffs continue to have this kind of negative impact on economic data, and to the extent that that negative impact begins to get reflected in financial markets, do we start to get to this point where tariffs become politically unpopular and there's pushback against them, and does the administration eventually start to wind those down? And to the extent that they do, is that problematic for members of Congress that have become reliant on this new fastest growing line item of revenue for the federal budget? So that'll be an interesting thing to watch this year. By the start of next year, though, we have this, I like the way you described that, not necessarily a pivot to accommodative monetary policy, but at least to no longer restrictive monetary policy. So you've got that moving in tandem with, you may love it, you may hate it, but the Big Beautiful Bill Act. And those together ought to be supportive of a somewhat faster pace of economic growth in 2026. So with that, we'll say thanks very much for joining us, and we'll look forward to talking to you again in September.